turn to the business of earnings, and Q3 has seen good numbers thus far. In fact, better than expected for a second consecutive quarter in a row. Now, why is it important to track quarterly earnings? Because it is a barometer of sorts of the health of Indian companies and in that sense, the health of the Indian economy. Poonam is breaking down the overall Q3 performance of Nifty 50 companies this time around.
Well, it's been a robust Q3 so far. This is the second quarter in a row wherein we are seeing very strong earnings. 60 companies, 60 Nifty companies by weightage have reported better than expected earnings. It's been a broad-based earnings recovery. Quite a few brokerages are also has also gone ahead and upgraded Nifty EPS. IT sector has outperformed for a second quarter in a row. We are seeing a strong deal pipeline, some good amount of guidance upgrades coming in. TCS, Infosys expect double-digit growth in FY22. Quite a few consumption players have reported good volume growth. Demand recovery is seen, and also coupled with festive boost. If you look at the metals, well, it's been a strong Q3 led by higher commodity prices and volumes. Banks have reported lower than expected NPA stress despite COVID. The fear of extremely high elevated NPAs is certainly not there, although banks have gone ahead and made higher provisions, and some of the top banks and top NBFC players are also expecting a credit offtake pickup. Cement, of course, have reported strong profits led by healthy realizations and cost savings, and metals, of course, has been a good sector this so far. IT, large banks, autos, durables, cement have seen EPS upgrades. Oil and gas as well as life insurance has seen EPS downgrades. Reliance has not participated in the rally so far on account of mixed earnings, but one thing is there, we are seeing cost pressures kicking in, and hence will we see a sustained recovery going ahead or not? That is the question, but so far a very strong Q3.
Corporate quarterly results have been fantastic for a second quarter in a row. Now, the bulk of Nifty 50 companies have declared their results. Most of them have nearly 80% in terms of weightage, and most of them have done pretty well. Look at this, for instance. Out of 33 companies that have declared their results so far as we speak, 21 have shown performance at above expectations. Now, why is this a parameter that we track? Because for one, it's some of the largest companies in the country. These are their own performances that they're declaring, so it's private data in the sense. And it also goes through a lot of scrutiny from analysts across the board to see if their numbers actually bear out. It tells us, in a sense, the story of the recovery of the Indian economy and how sustainable it is, how wide it is in its breadth. To speak to us more on this trend and what the numbers actually show us when you go and read between the lines, I'm joined now by Gautam Duggad. He is the head of research at Motilal Oswal Securities. Gautam, great to have you on the show. Let me begin with your overall comment on Q3 so far, and how does it compare with Q2? Now, Q2, we were looking at a lot of bounce back, right? The economy opening up, and suddenly, comparatively, everything was looking good. But Q3 was the question of sustenance and festive demand. Are you seeing those themes play out among different companies representing a wide section of sectors?
Yeah, hi Tamanna, good evening. So you absolutely said it. So 2Q was more about bouncing back from 4 or 5 months of lockdowns, a lot of cost cutting because travel was not happening. Companies were conserving their cost elements. And 2Q was the first quarter. Let me give you a context. For last 6 years, earnings have disappointed. And for that matter, even for a decade from 2010 to 20, if you see, the earnings for the 50 largest companies, which is what Nifty represents, have grown at a compounded rate of just about 6%. And that is 1/3 of what we had done in the decade from 2001 to 10, which was 16% CAGR. So we had gotten used to disappointments, companies missing earning estimates, and analysts downgrading those estimates ahead. So September came as a breath of fresh air, where for the first time in last many, many years, we had to upgrade our estimates and companies had beaten our expectations. right? And the fear in September was this may be one-off quarter, and then as costs come back and demand peters out after the pent-up demand, things may go back to usual. Thankfully, that has not happened. The acceleration that we had seen in September has further picked up pace in the December quarter. The numbers are so staggering that I'll give you just one statistic or data point. Our expectations for the 30 companies of Nifty which have reported earnings so far was just 4% profit growth. What we have got so far is 25% profit growth. And for the broader universe, which includes mid-cap, small-cap companies that we cover, out of the 105 companies that have reported, we have seen a profit growth of 32% versus expectation of 13%. And what is more pleasant about this is the fact that it is coming from variety of sectors. This is not a one company or one sector-led earnings up move. Every sector that we track has participated and it's beaten our expectations. And therefore, we've had to upgrade our earnings once again. So now we've upgraded in September, we've upgraded before this quarter began in January, and as we speak, we have once again upgraded the numbers. So there is a demand recovery, which is all encompassing. Every sector has seen demand recovery. Cost containment has continued. The margins that you see across different sectors which are part of the index, they have all expanded their margins ranging between 300 to 500 basis points. And consumption has revived, whether it is a discretionary consumer companies or staples, day-to-day FMCG companies, all of them have reported stupendous volume growth performance. So yes, fingers crossed, this is by far the best earnings season in a decade that we have seen.
Wow. Not to spoil that party, Gautam, but I just want to point out some of the factors which may lead to a question mark on sustainability. One is, are we looking at this at a relatively lower base? Even so, if I compare Y on Y or Q on Q, question number one. Question number two, is this also reflecting in a sense the festive season, which is traditionally a higher consumption period, especially in certain sectors and for some companies? And part three, is this still a continuance of the trend where companies are boosting their profits by cutting costs? Now, whether those are employee costs or expansion costs or any kind of other investments that they're making?
So let me answer that one by one. First of all, it's not on a low base. In fact, September quarter benefited from a low base. Relative to September quarter, December quarter has a higher base. And that's why our expectations was just about 4-5% growth, against which we have got 25%. So base is not helping. Number two, when you mention festive demand, because we are doing like-to-like comparison of October-December quarter this year versus the October-December quarter of 2019, that effect evens out because you're comparing like-to-like on a YOY basis, not sequential on a quarter-to-quarter basis. You're comparing October-December 2020 versus October-December 2019. So you had festive season in the base in 2019 as well. Of course, there is some element of pent-up demand because consumers have come back with vengeance after 6 months of being locked out in the home. So that is there, but that still does not explain a 33% volume growth that we have seen in Asian Paints, or a 40% top line growth that we have seen in Havells, or a 15 to 20% volume growth we have seen in companies like Dabur, Marico, Emami, and there are litany of companies which have reported good performance. Third question, what is your third question, if you can repeat? Sorry, I forgot.
No, my third question essentially was that are we seeing the continuing trend where companies are basically cutting costs to boost their profits, whether it's employee costs or whether it's, holding back on fresh investments?
So I think there is a bit of a myth here because second quarter, this narrative about companies cutting cost has got a very dominant, it became a very dominant narrative. Whereas the fact is in the second quarter, that is the September quarter, you had seen a massive 600 basis point of gross margin expansion. While there was overhead cost reduction, but that was not the driving force of earnings growth. The driving force was gross margin expansion. Third quarter, what we have seen is companies have maintained their cost initiatives, but some costs have come back now. For example, consumer companies, B2C, they've started advertising spends once again, right? Companies like Hindustan Lever, Dabur have reported 15 to 30% growth in advertising spend, which is an expense, right? IT companies have given wage hikes to their employees, right? At the margin, what has happened is because of the inflation, some of the commodity costs have gone up, and therefore gross profit margin, which is essentially sales minus the raw material cost, they've come off a little bit in some of the sectors. But because the demand has come back so massively, the impact of commodity cost increase has been nullified by the operating leverage, which comes from a higher volume growth. So clearly, what we are seeing is now demand getting stronger and stronger. And what we have seen in the budget gives me a lot of hope that this demand can sustain going ahead as well. So even if some costs come back as travel resumes, offices resume, some of the overhead costs will definitely come back into the P&L. But because your demand is also improving, and there is an element of inflation in the top line revenues because companies will increase prices, I think they will balance each other out. And that's why we are having an expectation of 35% profit growth for full year of FY22. FY21, we will do 15% profit growth for Nifty, which in itself is a commendable number because this is a year when 5 months economy was locked down. And we are doing in a pandemic year 15% of profit growth. Now, 16, 17, 18, 19, 20, which were normal years, you did just about 4-5% profit growth. And in a pandemic year, you are doing 15% profit growth. I mean, if I can stretch that argument a bit, in April, we were thinking that, in FY22, if we get even FY20 earnings back, that will be an achievement because FY21 was looking very bad then. We were thinking it may go down by 20% on profit terms. Instead, what we are now saying is it is going up by 15%. And on that base, we are expecting a 30% plus profit growth for FY22.
Wow. Let's hope that all of this boost in profits makes its way to investors in terms of dividend, to shareholders in terms of, EPS, as well as to employees in terms of hikes. And that's when it will really move the needle and make a difference. One more question though, Gautam. If you were to tell me how evenly spread this improvement in corporate performance is. Clearly, it will not be the same story in every sector and every company. But could you say this is a broad-based improvement?
It is a very broad-based improvement, Tamanna. In fact, this is as good as you can get it. Out of the 18 sectors that I track, 17 sectors have beaten our expectations. It's never happened in the past that it is such a broad-based performance. Yes, at the margins, cyclical sectors like cement, metals are having a much stronger momentum because they've been stagnant for a long period of time. And now commodity prices are going up, investment demand is coming back. So they are clearly benefiting from that. But banks have beaten our expectation, consumer companies have beaten, auto has beaten, cement has beaten, IT companies have been beating for last 3 quarters in a row. So it's as good as you can get it. You can just hope that this sustains for the next couple of years because India really had a decade of earnings recession. So it is important that this earnings delivery continues for at least a couple of more years. That is what will propel the markets forward because end of the day, there is a lot of news on a day-to-day basis. End of the day, what matters the most for stock markets is corporate earnings because they function, they act as the mother's milk for the bull market and also serves as a, it gets highlighted often that in the long run, stock markets always are slaves of earnings. So as I said, in the first decade of this century, we saw 15% earnings growth. Markets gave you 17% return. Second decade, we saw just 6% earnings growth. So markets gave you just 8.5% return. So that is what matters in the long run. And we are seeing a recovery after a long, long time.
Yeah. Well, let's hope the recovery sustains. It's in everyone's benefit if it does. And this is sort of one parameter that's important to track when we're looking at how the Indian economy is recovering. Thank you so much, Gautam, for speaking with us. Great to have you on the show.